Welcome to Crypto in 10 Minutes. We are launching into a deep dive today because, wow, the entire financial world is being squeezed by systemic pressure.
It really is.
We're looking at source material covering three major forces all converging right now. First, there's this escalating political war over who actually controls the money supply in Washington.
Right?
Second, a dramatic, a generational economic regime shift that's changing how everyone invests.
And that's a big one.
And finally, the urgent, immediate signals that are just screaming from the Bitcoin price charts and, altcoin tokenomics.
And that's the mission for you, the listener. We are cutting through all that high-level chaos to extract the crucial, actionable connections.
Right.
This isn't just news about the Federal Reserve. This is about understanding how macro instability, this infighting at the very top, how that translates into immediate tactical decisions you need to make about price targets and asset risks. We're giving you the systemic backdrop that's driving every meaningful move in crypto.
Okay, let's unpack this collision of monetary and political power first, because the headlines are truly astonishing.
They are.
We've seen the Department of Justice open an investigation into Fed Chair Jerome Powell.
Yeah, and not for what you'd think.
Exactly. This isn't some complex financial crime.
Yeah.
On the surface, the investigation is about testimony he gave regarding renovation costs for Federal Reserve buildings.
Right.
It sounds almost, cartoonish.
It does, but here's where it gets really interesting. Powell immediately responded by labeling the entire investigation as, and I'm quoting, retaliatory.
Retaliatory. So he's suggesting the real target isn't the building costs, but his policy preferences.
Exactly. Specifically, his setting of interest rates, which, flies in the face of the administration's wishes.
And the DOJ fired back,
Yeah,
right?
right.
They maintain that the U.S. Attorney's Office tried repeatedly to contact Powell about these cost overruns, and he just ignored them.
He just blew him off, supposedly.
Because this is way more than a squabble over receipts. This is dramatic power play.
It is, and we don't need to determine the legal truth here. What matters to you is the truth buried beneath the headlines.
Which is?
The illusion of the Fed's separation from politics is crumbling in real time. This is the inevitable collision of monetary power, wielded by unelected technocrats, and political power, wielded by elected officials.
So if the Federal Reserve is truly independent, the question becomes, why does it feel the need to insist so loudly that it is?
Exactly. Especially when you see global central bankers starting to band together in solidarity to defend Powell, it suggests this whole idea of independence is under extreme stress.
Maybe it's just a myth.
Maybe. And what's fascinating here is that this concentration of power leads directly to the core problem of inequality.
Right. Scott Bessent, a key figure in finance, he characterized the Fed as the engine of inequality.
The engine of inequality. That's a huge provocative claim.
It is. How is that possible? Most people think of the Fed as just trying to manage inflation and employment.
Yeah. Well, it's rooted in the fundamental structure of how discretionary money is created. You have to go back to what's called the Cantillon effect.
The Cantillon effect. Walk us through that simply. Why does new money always create inequality?
Okay, so imagine quantitative easing, or QE, as the Fed turning on a massive faucet of liquidity. New money does not enter the economy uniformly. It enters at the top.
Where the faucet is.
Right where the faucet is. So first, that liquidity floods banks and major financial institutions. They get to use that money when asset prices, stocks, bonds, real estate, are still cheap.
So they're the first ones of the party buying everything up.
Exactly. They fill their plates first. Next, that new capital reaches large corporations and government contractors, allowing them to fund projects and hire.
So by the time that new money actually trickles down to the average person in the form of, slightly adjusted wages or something?
Too late.
What happens?
You're showing up to the party after all the good food is gone, and you're now paying a premium price for the leftovers.
Because its purchasing power has already been hollowed out.
Completely hollowed out. Consumer prices, rent, gas, groceries, they've all risen dramatically because the asset holders got to the money first.
So inequality isn't a bug in the system, it's a feature.
It is a core feature of discretionary money creation. And this debate over central bank power, it's historical. It goes back before the U.S. Constitution was even ratified.
So the Fed's real mandate isn't inflation or employment.
Well, their de facto mandate often defaults to financial stability, which almost always means bailing out the financial institutions that are closest to that money faucet. And when people see that, trust just erodes.
That erosion of trust brings us directly into part two, this realization that the entire economic regime has fundamentally shifted. We're talking about massive systemic stress, which sources are connecting to a broader historical cycle. They're calling it the fourth turning.
The fourth turning. It's a generational crisis cycle, something that happens every 80 to 100 years. It's a period where institutions fail, societal models collapse, and things are rebuilt.
The last one was the Great Depression and World War II.
That's the one.
So we're basically comparing our current stresses to 1929. That is a dramatic shift.
It's a massive shift. And the sources emphasize this by contrasting it with the 40 years that came before. Think about 1980 to 2020.
Yeah, that was a golden era for investing.
Total tailwinds, rising stock prices, falling interest rates, falling inflation, globalization. It was, as they say, quite difficult not to make money.
It felt like gravity was reversed for 4 decades. We were conditioned to believe you could just buy the dip, and that was the retirement plan.
That environment is now dead. Inflation is sticky, rates are up, political volatility is surging.
So what's the consensus now?
The consensus from the strategists we review is that the next 10 to 20 years could be really hard to make money if you rely on those old strategies. You have to be active.
This reversal just makes that K-shaped economy you mentioned even worse, right? The gap between the haves and have-nots widens dramatically.
It widens into a chasm. The top leg of the K shoots up, while the bottom leg, wage earners, the middle class, just stagnates or falls.
And that outcome, of course, leads to a massive loss of public trust. You see it in every poll. Trust in banks, the currency, government, it's all collapsing.
And there's no single event that can just restore that trust once it's gone.
Which is where the peaceful boycott comes in. If you have low trust and a system designed to concentrate wealth at the top, people start looking for an exit, an opt-out.
That exit is Bitcoin. It's the voluntary, nonviolent boycott of the collapsing monetary system.
Because it's rules-based.
It provides a rules-based, trustless money that removes discretion from policy completely. And that is incredibly appealing to the growing number of people on the bottom end of the K.
The people who feel completely disenfranchised.
Exactly. By a system that keeps printing their purchasing power into oblivion.
It fundamentally shifts power back toward the individual.
It does. And since we can't trust the institutions, we have to rely purely on the data. So let's look at what the charts are telling us right now.
Let's turn to the immediate market signals. Bitcoin is off to a strong start, up almost 8% year to date. As of recently, BTC was trading strongly around $94,300.
And looking to close at its highest level since mid-November, that underlying strength is vital.
Yeah. Analysts are observing what they call collecting in the high $80,000 area. So big buyers are setting a base there.
And crucially, we've observed a clear pattern of higher lows since that sharp drawdown in November. That confirms demand is stepping in.
The resistance right now is that $94,000 to $95,000 area. It's been tested multiple times unsuccessfully.
That's where the sellers are waiting. Overcoming that is the immediate bullish catalyst we need.
And we zoom out a bit. The other bullish sign is that Bitcoin is fighting to get back and stay above that green line, the original bull market trend line.
Staying up that line maintains the long-term structural integrity of the rally. It's key.
So looking medium term, what's the primary upside target if we do break through 95K?
The next major challenge is the $108,000 to $112,000 range.
Okay, why that range specifically?
That zone is a huge psychological and trading barrier. It was a significant consolidation zone for over a year, stretching way back. If buyers can push through that 112K level, the path is clear.
But if we do reach that area, that 108 to 112, there's a serious risk warning we have to flag.
There is a big one. If Bitcoin reaches that zone, tops out without breaking through, and then breaks down materially from there.
What happens?
It confirms a massive bearish pattern known as a head and shoulders formation. And that's a classic signal that the long move up is exhausted and a deep correction is likely.
So the bullish scenario is consolidation in that range and then successfully recapturing 112K and moving higher.
112K is the ultimate line in the sand.
Yes.
Absolutely.
Okay, let's shift gears entirely. While the Bitcoin picture is relatively healthy, we have a critical tactical warning for altcoins, specifically for ONDO.
Yes, this requires immediate caution.
ONDO has already seen a significant drop from highs around $1.13 down to near 40 cents. What's the specific danger here?
The danger is a massive pre-scheduled token unlock. It's slated for January 18th, 2026.
And what does that mean?
This single event is set to increase the released circulating supply by a staggering 57%.
57% increase in supply. That sounds like an overwhelming tsunami of new tokens hitting the market all at once.
It is. We're looking at 1.94 billion new ONDO tokens potentially entering circulation.
Wow.
At today's price, that's an influx of nearly $784 million worth of supply the market has to absorb instantly.
That sounds almost impossible to absorb.
It will struggle mightily. And while ONDO has genuine utility in tokenized real-world assets, the market just won't be able to digest this. Tokenomics always precedes utility.
So what's the tactical advice then? How should you approach this?
Proceed with extreme caution. Honestly, investors considering ONDO might want to hold off completely until after that January 18th unlock plays out. Just wait.
And if you don't?
Well, if sell pressure is substantial, downside targets could easily test the 35-cent support level, or maybe even drop as low as the 26 to 27-cent area. This is a risk that's easy to avoid just by waiting.
So bringing all these threads together, this massive systemic stress means we are witnessing the acceleration of generational change.
We are. Trust in traditional institutions is collapsing due to decades of discretionary policy and rising inequality from that Cantillon effect.
So the optimal risk-reward trade in this environment is tilting toward hard assets.
Particularly sound money that removes political discretion. The goal, as the sources stress, is to position your portfolio both inside and outside the collapsing system to hedge against all this instability.
The ultimate goal is to own something that, quote, cannot be printed into oblivion. This shift is happening, and ignoring the systemic context is just. It's no longer an option.
The regime has changed. You have to adapt your strategy, or you're relying on old advice that is simply no longer applicable.
To help you navigate this massive shift and prepare your portfolio for the coming years, we have prepared an ebook detailing exactly how we're positioning our assets right now against this systemic stress. Finish this deep dive by subscribing to our Substack and get their ebook.